The Texas real estate bubble is finally bursting, and some markets are falling faster than during the 2008 financial crisis. In the last quarter alone, home prices in these 12 markets have plummeted by up to 18%, with foreclosure rates that have doubled since last year. The Texas real estate story has always been one of bigger, better, and bolder. Until now, the Lone Star State's reputation for limitless growth and opportunity attracted millions of new residents and billions in investment dollars over the past decade. Today, we're diving deep into the 12 Texas real estate markets experiencing severe downturns. Whether you're a home buyer looking for your next property or an investor protecting your portfolio, this information is crucial for your decision-making in 2024. Austin metro area, the tech bubble deflates. The Austin metro area, once a beacon of tech-fueled optimism, is now grappling with the harsh realities of an economic downturn. Home prices, which soared to a median of $525,000, have fallen sharply to $452,000 in just 6 months, with luxury properties over $1 million experiencing even steeper declines, some selling for 25% below their initial asking prices. Housing inventory has surged by 145% year over year, with the average time on market increasing from 15 days to a staggering 65 days. Meanwhile, 68% of listings have undergone at least one price reduction, and new construction inventory has swelled to an unprecedented 8.2 months of supply, nearly triple the level of a balanced market. The tech sector, once Austin's lifeblood, is at the heart of this downturn. Since January, 42 companies have laid off 12,847 workers, representing a staggering $1.2 billion in lost annual wages. Major players like Tesla have slashed their hiring targets by 65%. Meta has abandoned plans for a downtown office expansion, and Google's project delays are casting a shadow over the city's economic future. Apartment occupancy has dropped to 89%, the lowest level since 2009, while restaurant revenues in tech-heavy neighborhoods have plunged by 28%. The ripple effects extend to the real estate market, where nearly half of buyers from 2022 and 23 are now underwater on their mortgages, raising fears of strategic defaults. What was once a city compared to Silicon Valley is now drawing uncomfortable parallels to the dot-com bust. The shift in market psychology from FOMO to fear is undeniable, leaving Austin to confront the sobering aftermath of its tech-driven boom. Houston's energy corridor reveals a perfect storm of hybrid work adoption and transformation within the energy sector, exposing a deepening economic crisis in the region. Traditionally supported by oil and gas giants, this area now faces unprecedented challenges, with commercial vacancy rates soaring to 28%, the highest in 15 years, and leaving 2.4 million square feet of office space unoccupied. Energy companies are downsizing their footprints. ExxonMobil shed 500,000 square feet. Shell consolidated 3 buildings into one, and BP reduced its campus footprint by 38%. These shifts have rippled through the residential market, where home prices have dropped 12.3% year over year. Foreclosure notices surged by 87%, and 44% of homes are selling below their previous sale price. The average price per square foot has plummeted by $42, leading to a staggering $8.2 billion decline in total market value across the corridor. The fallout extends to local businesses. Retail vacancy rates have climbed to a record 18%, and restaurant closures have surged by 35% compared to last year. Once a vibrant hub, the energy corridor now serves as a stark reminder of how the shift in corporate strategies and economic forces can reshape entire communities. The corporate relocation slowdown in North Dallas suburbs. The northern suburbs of Dallas, once celebrated as America's fastest-growing corporate hubs, are now experiencing a dramatic reversal. Areas like Plano and Frisco, which thrived on a booming corporate relocation pipeline, have seen median home prices plummet by 13.2% and 15.7% respectively over the past 9 months. The median price has fallen from $625,000 to $542,000, with nearly half of all listings undergoing price reductions. Luxury homes taking the hardest hit. Meanwhile, new construction permits have dropped 28.3%, leaving ghost streets of partially completed developments, while builder confidence has hit its lowest level since 2012. The corporate relocation pipeline that brought 23 major companies in 2022 has dwindled to just 4 confirmed moves for 2024, a 95% decline in projected new jobs. Office leasing activity has dropped 65% year over year, with existing companies shrinking their footprints by an average of 30%. Investor-owned properties are flooding the market, and rental vacancies have surged 15%. This downturn is reverberating through local institutions. School enrollment has declined for the first time in over a decade, with Frisco ISD reporting a 3.1% drop. Property tax revenues are projected to fall $89 million short of 2024 budgets, forcing cuts to municipal services. Once a symbol of Texas's economic miracle, the northern Dallas suburbs are now grappling with significant economic challenges, telling a stark story of market reversal. San Antonio's Northwest region, an infrastructure and economic crisis. San Antonio's Northwest Corridor faces mounting challenges due to uncontrolled growth, as infrastructure originally designed for 250,000 residents now strains to support a population exceeding 400,000. This unsustainable expansion has led to systemic failures, including a staggering 312% increase in water main breaks year over year and traffic congestion that has doubled commute times. Property taxes have risen 12% annually for 3 consecutive years, forcing many longtime residents to sell their homes, resulting in a 218% increase in housing inventory. The economic repercussions are equally severe. The region's largest master-planned communities report a 38% cancellation rate on new home contracts, and home values have declined for the first time since 2011, with the median price dropping 8% in just 6 months. Uncertainty surrounding military base realignment jeopardizes 15,000 direct and 45,000 indirect jobs, further destabilizing the local economy. Meanwhile, commercial development has stalled, with new permit applications plummeting 45% and retail occupancy rates falling to 82%. San Antonio's Northwest region exemplifies the consequences of unchecked growth, highlighting the urgent need for strategic planning and investment to address these interconnected crises. The Woodlands, once heralded as Texas's premier master-planned community, now faces unprecedented challenges across multiple sectors. Luxury real estate has been hit particularly hard, with home sales plummeting 22% and million-dollar properties languishing on the market for 189 days, more than quadruple the 45-day average from last year. Premium neighborhoods like Carlton Woods have seen property values fall by 18%, with $4 million homes struggling to sell at $3.2 million. The downturn extends beyond residential real estate as the community's corporate landscape transforms dramatically. Major tenants like Occidental Petroleum and Chevron have significantly reduced their footprints by 60% and 45% respectively, contributing to a concerning 32% corporate campus vacancy rate. The commercial sector shows similar strain, with the Woodlands Mall losing 22 tenants in the past year and restaurant receipts dropping by 35%. The community's commercial town center now reports a 28% vacancy rate, with high-end retailers like Nordstrom scaling back operations. Perhaps most telling is the first-ever decline in school enrollment, a 4.2% drop that marks an unprecedented shift in the Woodlands' 500-year history. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, back to what I was saying. Fort Worth's Alliance Corridor, once poised for dramatic growth, now faces mounting challenges across multiple sectors. A staggering 25% new home cancellation rate has resulted in $342 million in lost contracts, while an 18% spike in property tax assessments has triggered the area's first negative net migration, minus 2.1%, since 1992. Major employers BNSF Railway and Charles Schwab have frozen expansion plans, eliminating 3,800 projected jobs. Infrastructure woes plagued the region, with I-35W suffering from gridlock and newer developments experiencing chronic water pressure problems. The Alliance Airport expansion, intended as an economic catalyst, has instead seen cargo volume plummet 15% and lost construction commitments from 3 major logistics companies. Adding to these concerns, local school districts now face a $45 million budget shortfall as enrollment numbers continue to decline. Round Rock and Georgetown, Austin's northern satellites, are experiencing acute tremors from the tech industry downturn. Dell Technologies, the area's largest employer, has dealt the heaviest blow by eliminating 6,650 positions, while Samsung slashed its expansion hiring targets by 40%, and Apple's nearby campus operates at just 35% capacity due to remote work policies. The housing market reflects this economic upheaval, with median home prices plunging 15% from $485,000 to $412,000, and new construction inventory languishing at 12.2 months supply, forcing builders to offer incentives as high as $85,000 per home. The rental sector shows similar distress, with apartment complexes reporting 22% vacancy rates and an 18% decline in rental prices. Perhaps most telling is the fate of the Domain North development, which was positioned to rival Austin's tech corridor but now sits indefinitely postponed after securing only 2 tenants for its ambitious 2.8 million square feet of space. Katy, Houston's western suburb, faces mounting challenges that extend well beyond typical market forces. A devastating FEMA flood map revision has placed 15,000 additional homes in high-risk zones, triggering a dramatic 325% spike in insurance premiums for affected properties. This environmental reclassification has rippled through the real estate market, forcing new home builders to slash prices by 10 to 15%, a reduction that represents $268 million in lost value across 5 major developments. The impact extends to the education sector, where school district growth projections miss their target by 42%, creating a problematic imbalance of underutilized new campuses, while older schools grapple with $89 million in maintenance backlogs. Commercial development has also stalled, as evidenced by the Grand Via mixed-use project, halting construction after completing just 30% of its planned space. Adding to these woes, local employment has dropped 8.2% as both energy and retail sectors contract. Richardson telecom corridor disconnect. Richardson's once bustling telecom corridor is experiencing unprecedented challenges across multiple sectors. A wave of office to residential conversions has introduced 1,200 new apartment units to an already saturated market, pushing vacancy rates to 18%. The tech industry downturn has hit particularly hard, with 4,500 local jobs lost to layoffs and Texas Instruments scaling back its expansion plans by 60%. Adding to the economic pressure, property taxes have surged by 15.2%, the highest increase in the Dallas Metroplex, while aging infrastructure demands $234 million in critical updates, straining the city's budget. The real estate market reflects this decline, with median home prices falling from $425,000 to $368,000, and over half of listings requiring multiple price reductions. The commercial sector hasn't been spared either, as 28 restaurants have closed their doors in the past year, and retail vacancy rates have climbed to 22%, painting a picture of a once thriving corridor in transition. New Braunfels, growth pains intensify. New Braunfels is facing a perfect storm of challenges as its rapid growth collides with mounting obstacles. Water rights disputes have brought 12 major developments to a standstill, freezing plans for 8,500 new homes, while the flagship Veramendi development teeters on bankruptcy after completing just 15% of its promised construction. The real estate market reflects this turmoil, with property values falling 12% and inventory levels soaring 245% above normal, forcing price reductions on 55% of listings. The economic impact extends beyond housing, as tourism has plunged 28% year over year, affecting more than a third of local businesses. The job market has contracted by 8.5%, with the manufacturing sector particularly impacted after 2 major employers relocate to Mexico. Meanwhile, the strain on local infrastructure is evident in the education system, where over 8 schools have resorted to portable classrooms to manage capacity issues. Adding to residents' burden, property tax rates have jumped 16.2%, creating additional pressure on a community already grappling with significant changes. Pearland, southern suburb struggles. Houston's southern suburb of Pearland is facing mounting challenges that threaten its stability and growth trajectory. A devastating expansion of flood zones has impacted 12,000 properties, driving annual insurance costs up by $4,200 per household, while construction quality issues plaguing 15 new developments have sparked class action lawsuits and widespread property devaluation. The retail sector has taken significant hits as major chains including Target and H-E-B have canceled planned locations, contributing to a concerning 25% vacancy rate in existing retail spaces. Making matters worse, population growth has fallen 65% below projections, leaving expensive infrastructure investments underutilized. These compounding factors have resulted in a 16.8% year-over-year decline in property values, the most severe drop among Houston's suburban communities. Cedar Park, tech tremors and growing pains. Cedar Park, a northwest Austin suburb, is experiencing severe economic turbulence as its tech-dependent economy falters. The housing market has reached concerning levels with 8.9 months of inventory, while numerous construction projects remain frozen at 68% completion. The ripple effects of a tech industry slowdown have eliminated 3,200 local jobs, with the area's startup ecosystem showing signs of collapse as incubator occupancy plummets to 35%. Commercial growth has ground to a halt, exemplified by the cancellation of the 1890 ranch expansion after securing only 15% of needed pre-leasing commitments. The strain extends to the education system, where capacity issues forced a redistricting that disrupted 4,200 students and contributed to an 8% enrollment decline. Meanwhile, a steep 22% property tax increase over 3 years has forced many long-term residents to sell their homes, further destabilizing the community. The ripple effects across Texas's major real estate markets paint a stark picture of economic upheaval. Total market value has plunged $42.8 billion with no signs of stabilization, while 89,000 direct jobs have been eliminated and 12.4 million square feet of commercial space sits vacant. The fiscal impact runs deep, with property tax revenue shortfalls hitting $324 million and infrastructure maintenance backlogs reaching $1.2 billion. Population trends signal a concerning exodus, with new negative migration in 7 of 12 major markets, while school enrollment has dropped an average of 3.2% across affected areas. The business landscape shows similar distress. 4,200 small businesses have closed their doors. New construction projects face average delays of 4.7 months, and builder bankruptcy filings have surged 284%, highlighting a fundamental shift in Texas real estate dynamics that extends far beyond typical market cycles. These market declines share common threads. The impact of rising interest rates, which have increased monthly payments by 40% year over year, economic shifts including tech and energy sector volatility, and fundamental market issues like overbuilding and infrastructure constraints. Property tax increases and soaring insurance costs add pressure across all markets. For home buyers, this changing landscape presents both challenges and opportunities. The key is patience and thorough research. Consider renting until markets stabilize, and when you do buy, negotiate aggressively. Look beyond new developments to established neighborhoods, and always research flood zones and insurance costs carefully. Investors need to adjust their strategies for this new reality. Focus shifts from appreciation to cash flow, while opportunities emerge in distressed properties. Secondary markets may offer better returns, but higher cash reserves become crucial. Watch demographic shifts and corporate relocation trends closely to anticipate market movements. The Texas real estate story isn't over. It's entering a new chapter. While these markets face significant challenges, remember that real estate is cyclical. Today's crisis markets may become tomorrow's opportunities, but only for those who understand the risks and plan accordingly. Whether you're a home buyer dreaming of Texas living or an investor looking for opportunities, staying informed is crucial. In real estate, timing isn't everything. It's the only thing. Stay informed, stay prepared, and stay ahead of the market. Please share this video with anyone interested in Texas real estate. Drop a comment with your thoughts or questions about these markets. And thanks for watching. Don't forget to like and subscribe for more real estate market insights, and watch this one as well.